said connecting. That's good.
Good. Hello, everyone. This is Len Yates, president of OptionVue, and we'll be talking today about version 7.30, just released this morning. Now, let me take a moment to share the desktop. Okay. At this point, everyone should be able to see my OptionVue program. And quite a lot of improvements went into this 7.30 version, but the main one is a new horizontal skew model, which is really going to be the only focus of my talk today. It's quite a deal, and I think quite an important step in terms of modeling options the way they really behave and how they really respond to price movements in the underlying. So I'd like to begin by talking about, well, as I began this project, I realized that a couple of things were foundational to it, and one of them was data. We needed some data that we didn't have before, so I needed to construct it. Now let me begin by showing you what this data looks like. If we bring up a volatility chart, the usual mode that you would see in OptionVue would be these two lines, IV and SV, but there's a new button here with an M on it, and when you click that, the program toggles between a new 5-line mode and a single-line mode. So now instead of having just one IV line, we have 5 IV lines, and also statistical volatility, also a total of 6 lines. The blue line represents near-term volatility, the 30-day. Then the green line represents 60 days, and so on. We've got terms all the way out to long-term 2-year implied volatility. So this has been gathered on all of the assets that we represent here at OptionVue, everything that has options, all the way back to 5 years ago. So we have 5 years worth of data to use, and perhaps at some point I'll pursue deepening that history. But the next thing I want to show you is perhaps one of the most interesting things about this model, and that is that you get to look at a volatility cone now. If you just click to place the wand on the chart, this volatility cone shows up. And the cone shows you the term structure of volatility. And if you're not familiar with that, I hate to say the word term, but if you're not familiar with that word term structure, think of it like this. We're all used to saying short-term and long-term, right? Well, a term structure shows you short-term, medium-term, and long-term all at once. So that's what a term structure is. And actually, when we're talking about the new horizontal skew model, we're talking more officially about a term structure model. So that's what this is. And maybe you've noticed that as you move the wand, the term structure changes and goes all over the place. And by the way, the shaded area in the volatility cone represents the extremes that we've gone to during the past 3 years. So at some point during the past 3 years, we went all the way to the low point. Let's see if we can find that. This comes pretty close. And we also went very high, and I'm sure that that would have been probably in the fall of 11. Yes, so there's where the term structure reached its highest point during the last 3 years. So maybe you can begin to see that this volatility cone is going to be very useful as you may analyze, for example, earnings announcements. Apple had an earnings announcement 3 months ago, and IB soared at that time and then suddenly dropped right after the announcement. See that drop? And then 3 months prior to that, again, very high IBs and then a sudden drop. I hope you can see that. So this data, this historical data was foundational to creating the model. And it comes with your price data. So whenever you're updating your price charts, you're also updating these volatility numbers because they're stored in the same files, okay? Now, let's see. Oh yes, a good point I want to make is that notice that we're missing today's numbers. You will not have today's numbers on the chart if you have not opened the matrix yet today. I have not opened my Apple matrix yet today, so I will open it now. And now that that's updated and we can return to the chart, perhaps we need to reopen it. Let's reopen that chart. Yes, now we have today's numbers. So that's how you extend the chart to include today's numbers. Just open the matrix. Now the other thing that was foundational to making a model as sophisticated as this, and I'll bring up PowerPoint here, is CEV data. We needed new CEV data. Now, what is CEV? Just as a reminder, CEV is constant elasticity of volatility. And that just simply means we're measuring the degree to which IV numbers change in response to price changes in the underlying. And CEV is an industry standard term. We did not make that up here at OptionVue, so we're just using an industry standard term. Now the thing that's new is that instead of having just one CEV number per asset, we now have 15. And that's so that we can more appropriately model CEV according to the situation. Okay, so for example, let's say we're looking at a short-term option that's got 30 days of life remaining, and we're looking at modeling a move that takes place in just one day. Okay, then the CEV that's appropriate for that situation is 0.837. And I should probably remind you that numbers that are below 1 indicate an inverse relationship between price and volatility. Okay, I think everyone understands and probably knows that stocks always have CEVs under 1, which means that when price falls, volatility increases, and when price rises, volatility decreases. So with all stocks and stock indexes, you will see CEV numbers that are less than 1, and that shows that inverse relationship. By the way, there are some assets, especially in commodities, that have a CEV greater than 1, and in those cases, when price goes up, volatility goes up, and when price goes down, volatility goes down. And so, again, just to show you another example, maybe we're looking at an option that has about 90 days of life remaining. And I didn't mean to change that. Let's see if we can put it back there. And we're looking at the underlying making a move in 5 days or so. Then the appropriate CEV that the program will pick to use is 0.915. Now, I found that as I did my studies that there really wasn't much point in taking in numbers that were above 10 days in terms of a move. As you go out in time, as far as the number of days for the movement, the numbers really didn't change very much in my observation. So this 30-day number of 0.904, for example, just stayed 0.904 from then on as you went farther out. So it's sufficient, I found, to have this 1, 5, and 10 in terms of the quickness of a move, and then the option durations of 30, 60, 90, a year, and 2 year. Now, what if you have an option that's expiring in 15 days? What do we do with that? Well, we would need to extrapolate, and that's just what the program does. So you have the 60 that's at 0.87, and then you have the 30 that's at 0.837. The 15-day number is going to be somewhat less than this 0.837. You just extrapolate it out linearly. Okay, and that's what the program does. Or if you need a number that's in between some of these numbers, then you use what's called interpolation. And again, using linear modeling, you just find the number that's between there. So for example, if you had a 45-day option and you needed the appropriate CEV number, the program would take the perfect average between this number and this number. And I hope that's clear to everyone. Anyway, this is pretty technical, but that's really all I wanted to say about it. So let's turn our attention back to the program now and get back to application. Okay, let's open a price line matrix. I was looking at that earlier. And I'd like to introduce you to the new model. You would find it in the program using Model, and then click Volatility. And this will look all different to you. We have a new tab for horizontal skew, and then the next tab is vertical skew, and some of this will look familiar to you. All we did with this table here is widen it so you can see more months. And then a few miscellaneous things under the Other tab. But back to horizontal skew, what we have here in the upper right corner is a repeat of the volatility cone. And the term structure depicted right now is the current term structure. Okay, so we currently have term structure that has higher nearby volatilities and then less and less as you go out. This bottom section is put here pretty much just to illustrate CEV for you. In case you've never truly grasped CEV, this ought to do it for you. The horizontal axis in this chart is the price of the underlying, with the current price in the center. And the vertical axis is volatility. So if you may see that the lines go up as you go down, and that's simply showing you that volatilities increase if the price of the stock goes down. And then conversely, if you go up to higher prices, then volatilities decrease. And you can see what's happening to the term structure up in the volatility cone display at the same time that I do this. Okay, just release the mouse and this reverts to showing the current term structure. But that's something you can play with. Right here in this table, we are showing 5 of the 15 CEV numbers. I'll tell you which ones we're showing. Let me return to PowerPoint, and I'll show you. We're showing the 5-day move ones. Okay, so these are the 5 numbers that I show in that screen. I just didn't want to include a big table of 15 numbers. So I thought it was sufficient just to show 5 numbers here to give you something to refer to. Now, I meant to start this at 0. Okay, so we really weren't displaying the current term structure, but now we are. Okay, now let me show you something really cool. If you want to project an increase in volatility, you simply drag this red dot higher. Or if you want to project a decrease, drag it lower. And as you do that, you'll see the numbers in the table on the left update. And right now, we have left this dot on projection of an increase of 6% in the 30-day volatility number. And then you can see that lesser and lesser increases apply as you go out the term structure. And that's just the way it should be. This 6% increase brings us to 41.2. If we had no projected increase, and I'm just clicking, that button there is a reset button. So you can click that to reset. And we're back to current volatility of 35.2, which we might be able to see in the matrix. Just have a look here. Just so happens we have options that with exactly 30 days of life left. So we're looking at the monies 35.2, so that should be, and we have to count the puts too. Well, they're at 35.2 also. And then back into model volatility, there's our 35.2. So that may help you relate to, you know, what this is relating to. So now notice that if you project an increase or a decrease from the current term structure, then CEV automatically disables. I'm assuming that if you want to project a certain term structure, that you really don't want the program on top of that modeling other variations. When you model a term structure this way, I think you're trying to tell the program this is exactly the way it's going to be. And so you wouldn't want to have something kind of surprising you in the background as far as adding additional adjustments. However, if you don't, so we automatically disable CEV. However, if you want it enabled, you can click it back on, and then it's enabled. And if you ever click the reset button, we also automatically enable CEV modeling. Now look at this. If you'll notice that if we project a decrease in volatility, all the dots get dragged down with it, and maybe too much sometimes. You can click drag each of these individually and make the term structure just the shape you want. As you do that, all these 5 numbers change over here, and whatever you put here is going to be modeled in the graphic analysis, where we've got, looks like we've got a long straddle here being modeled, and in Trade Finder, okay? So this transfers over into graphic analysis and Trade Finder. Now, once you're in a graphic analysis, all you have to do is hover over this Volatility Change label and click it to get back to the model volatility screen. You can make a change here, click OK, and the graph will instantly update to reflect your change. And this number here, this minus 3.8 we're seeing right now, that should be the same number as this 30-day. So, and that's the case throughout the program now. Wherever you see volatility change, and there's a number of places where there's a volatility change field, when you enter a change number there, you're entering a number usually that is a 30-day IV change. And that reminds me, I think I should go back to the graph just for a moment and show you something, because this is important. In the past, our blue line, our IV line, has not necessarily been a 30-day number. In fact, it's been something like 45 or something longer, because we've always included options that go out to as much as 90 days, I think, something like that. But that's no longer the case. The blue line is now always a 30-day line, whether you're in this mode or not. Notice how that when I toggle this, the blue line doesn't change back and forth. So the blue line is 30 days, and everywhere in the program that you're working with a volatility, you're working with a 30-day volatility, and that includes these numbers here in the matrix. Okay, so we've standardized the program to a 30-day volatility. What else now? Maybe I should have a look at what questions are coming up. See if there's any questions coming in. Yeah. How do I, Jim, how do I see my operational panel? Just a moment. A question about earnings dates. You know, I'm coming to that in just a minute. That's perhaps one of the most exciting things to talk about yet. Events, yes, modeling events. Let's see another question here. Yeah, here's a question about the 60-day number. And yes, if there is not a 60-day option to measure from, and usually there isn't, then we have to interpolate and arrive at that 60-day number by using some options that expire prior to 60 days and options that expire after 60 days. So it's just a matter of a linear interpolation there. That's a good question. Okay, let's get into event modeling because we have definitely accommodated that, and we know that a good number of our OptionVue users are trading earnings announcements and other announcements that take place. So let's, what stock do I want to use? Well, we could stay with Priceline. And the first thing that I would say to you is look at this IV jump right here between the weekly ones, currently at 30.3, and then the weekly twos at 37.9. That's telling me that there's an event between August 3rd and August 10th. And by the way, this is new to show the date in these header fields. So I hope you like it. And that's somewhat customizable. You can read about that in your release notes. So there is an event between August 3rd and August 10th, and actually when I look at my OptionVue notes, I can see that there should be an announcement between August 5th and August 12th. And by the way, I did not type all these dates into my OptionVue quotes matrix, my quotes display. They came in here automatically with a new function that's in development. These dates were actually picked up from the website earnings.com and filled in for me automatically. So I'm preparing to release that with the next release of the software. So you can look forward to that. All I have to do is, you know, let me just show you. I type Control-E. When I hit Control-E, the program goes and refreshes every one of these dates and puts whatever earnings.com has right here in my notes field. And so I don't know exactly what the date will be, but let's just use, for sake of example, August 7th. So getting the matrix back up here, and knowing that this expiration right here is the nearby involved in the event, I will highlight that column, then click Model Volatility, and this field right here is automatically picked up on that weekly 2. Okay, so now the term structure is not showing as 30 as the first dot, it's showing as W2 as the first dot. And we'll be modeling whatever happens using this W2 onward, because we don't care about any expirations prior to that. That should be obvious. Now this field, this is a new field here for the event date. I'll put in August 7th. And now that that event date is here, and we have chosen a particular expiration to use as the nearby, we can now simulate what will, you know, without a doubt be a drop in volatility. Now, how far should we drop this to? Well, for that, you probably would want to refer to the volatility and price charts to see what kind of a drop has happened in the past, but let's not divert right now. Let's just say that, for sake of example, that the IV will drop to 32. Well, you know what? Let's refer to the options. The options here are 30.7, so perhaps that is the reasonable floor level to use. If we put in this 30.2 here, then that's indicating a drop of 8 percentage points for the W2. And offhand, it seems unreasonable to me that these are not flat, so I'm going to just artificially flatten them by doing this. Or another way is to type zeros in here, 0, 0, 0, 0, whatever your pleasure is. anyway, with this term structure modeled, we could then do our what-ifing. Okay, we have, let's change this to a short straddle because I'm not sure a long straddle makes sense. Well, maybe it would, but let's go with a short straddle. And then in the graphic analysis, we see that one of the lines has automatically been put on the event date, T+20, and the evaluation of the event is already displayed for us. And so that's, we can increase the number of lines if you like, but the event date being T+20, and there's a reminder here in the lower left showing you there's an expected event modeled at T+20. Okay, and now let me show you another thing that's new. If you click D for details, there's a new column here that shows you exactly what the projected volatility is that's being used. Okay, so we're projecting this drop to the 30.1, calls and puts the same, and that would be the basis for the analysis then. If we were not modeling this drop, and that could easily be done by me typing a 0 here, then you can see that this would be the performance you'd be looking at. But with the drop of 8%, then this is what we were looking at. And we've got break-evens of 831 to the downside and 968 to the upside. And if your preference is to believe that price line will stay within those bounds, then perhaps a short straddle is what you'd be looking for. And we could experiment with short strangles, with iron condors, butterflies, whatever you like. In fact, with the model set up this way and the term structure set up the way it is, you could use Trade Finder and ask it to, let's just set it to work on price line and a target of a bell curve. Excuse me. Excuse me. Anyway, you could set up your target, and the date needs to be that same August 7th, I believe I said. Choose your strategies and set your goals, and you could go. And this may help you locate a truly profitable trade. Now, I just thought of another thing I ought to point out while that's working. Notice that a lot of these announcements will be after the market close. We've got Apple, for example, coming up pretty soon here. Apple's announcement is on the 23rd next week. I believe that's Tuesday. But this being after market close, it's important that you put in the date 24th of July, because the first full trading day after the announcement will be the 24th. Now, on the other hand, if it says BMO, then you can put that precise date. But if it says AMC, then you'd better put the date after this indicated date. I hope that's clear. Now, let's get that matrix back up. And I'd like to show you one more thing, and that is, besides modeling the sudden drop, you can also model the buildup that will take place leading up to the event date. So all you have to do actually is indicate an increase, and that switches the program over entirely to, instead of modeling any sudden drop, it just models this increase that will take place in a linear, gradual fashion between now and just before event date. Okay, so now if we do a graphic analysis of that, we will see that the program projects to T+19. Remember, that was T+20 before. It's important that it project to the day before the announcement, so that's what it does automatically. And then you can experiment with possible positions to take advantage of the ramp up in IV, if you like. There's been a request, of course, to model both the ramp up and the sudden drop, but right now we do not model both. We can only model one or the other, and so that's the way it is right now. Again, if you indicate an increase that's going to happen, then that tells the program to model the gradual increase. But if you indicate a decrease that's going to happen, then the program assumes that that decrease will happen suddenly on the future event date. By the way, this is a drop-down also, and you can pick different expirations here, or you can pick the 30-day IV, which was the default. Okay, now let's see if we've got questions I can handle. Let's see. Can we be able to sort by earnings announcement date? Yes, I hope to be able to develop that in that new feature in the quotes display. One person said no audio, Len. I hope that that's not a problem for everyone. Can we see the earnings announcement date on the chart, on the price chart, or on the analysis? Here in Analyze, it is telling you that the announcement is T plus 20. An announcement date on the price chart, no, that would be a future feature that would need to be developed. Let's see now. People say they hear me fine, so I assume that's fine. Can you go through how this might affect TradeFinder? Well, it affects TradeFinder foundationally, and every option trade that it might model is using this horizontal skew model. You know what? I worked up a diagram. Let me bring PowerPoint back up here, and I view the horizontal skew model as being foundational to the vertical skew model, and I think this is a perfect way to visualize it. Every one of these little curves is the vertical skew model that's always been there, but you can picture them as riding on top of the horizontal skew model, kind of like their base. And look what happens if the term structure changes. See how the vertical skews will just float on top of that and move up and down with it. So that's the way the model works. And I thought that this would be a good illustration to help you visualize it. Well, I think that that's just about all that I intended to go over today. And my hope is that you'll find new ways to trade with this and make money. And you know, I've heard from more than a couple people that calendars don't seem to be working very well lately. Maybe this is just the tool you need in order to go in and figure out why those are not working. My hunch is that it's just a matter of looking for the right spots, the right situations for putting them on, and maybe just put them on at the right times when the term structure is just the way it should be. Well, and obviously that would be, you know, a curve, how shall I say it, a curve going which way. Here, let's get this. Let's get a chart up here. Perhaps calendars ought to be put on only when the term structure looks like this. Okay, I don't know that for sure, but you now have your tool for researching it, and I hope all of you make a lot of money. Anyway, let's see. Will BackTrader use the new term structure? Yes, absolutely. Presumably only 5 years worth. The 5 years is just the historical data that you can view. And I should say that the CEV numbers have been derived from 10 years worth of data. Okay, so every CEV number, all 15 of them in fact, are recalculated every day by our servers based on the previous 10 years of data. So that's there. Yeah, backwarded. That's the word I was looking for. Yeah, maybe you should put the calendars on only when the term structure is backward. Let's see, what else here? Yeah, thanks for the compliment. Great changes. An earnings calendar on IBM worked like gangbusters today. That's good to hear. Can you tell me exactly when the existing position included drop-down appears? It seems random. Existing positions included. On what form would that be? Would that be in a matrix? Yeah, I just can't recall. Right now, I'm not sure what you're talking about. Well, I think that we're just about out of time, so we may just wrap it up now. Is backwardation included in the survey function? No, survey wouldn't have to do with this. You know, survey doesn't need the horizontal skew model whatsoever. It doesn't relate to it. Okay, I'm going to wrap it up now. So thank you, everyone, for attending, and good luck in your trading. Bye.